Hubertus Mühlhauser, earnings just came out yesterday for Manitowoc Foodservice. But before we talk about the earnings, let's talk about the stock. You're up over 30% since you were spun off from the Crane Company back in March, so I guess it feels pretty good to be independent.
Yeah, it's still very, very nice. I think we had a very, very good start. 2 very strong quarters into the year, and our restructuring journey is fully on track, so we're very pleased, yes.
Well, that said, stock sold off yesterday because you missed Wall Street estimates both on the top and bottom lines with regard to your food processing machinery. What happened?
Well, I think we beat earning estimates or profitability estimates, and we improved another 200 basis points our EBITDA margin, which is our prime focus this year. I think we said all along that this year is a transition year, and we would like to spend the right amount of time of restructuring our business, correcting the issues of the past. So therefore, looking at the quarter with 16.1%, we're actually very, very happy with the numbers. And we have kind of seen some softness on the QSR side, which is the reason why we slightly guided down by 1% on the sales line. But as said, I think we're fully on track, and we had a very solid quarter with 16.1% profitability.
Can you talk a little bit more about softness in the QSR, quick service restaurant business? We keep hearing about a so-called restaurant recession. Will that filter back to you?
We don't see a restaurant recession, for sure not. I mean, overall, the restaurant industry is still up. What we're seeing, though, in the first quarter and the first 2 quarters, I must say, specifically in the last 2 months, is a little bit of a softness on the QSR side. And that actually plays into our long-term strategy. So I would see it not as a negative. It might be, 1 percentage point for us as a headwind this year. But long-term, I think this just shows the trend that the QSRs are under cost pressure. They have to improve their cost structures, so they have to decrease their energy costs, they have to decrease their labor costs, they have to decrease space, they have to manage waste better, and all that needs new equipment, and that's basically fueling our sales. So we're actually seeing a fairly stable restaurant industry, mildly growing by 1 to 2%. And secondly, I think we're in both segments. We're on the fast food channel, to the QSR, and we're also in the general market. So we have very good possibilities to hedge one with each other. And that's the reason why year to date we're up in constant currencies by 1.5%. So we're doing okay.
And during the conference call, you also talked about how you were right-sizing your business as well. And this means closing some plants here in the U.S., increasing some capacity in Mexico and China. This is a very touchy political issue because we're hearing it a lot on the campaign trail. So talk about how that's affecting you and whether or not you're hearing it from the local constituencies.
Yeah, well, I don't want to talk about politics here. Let's talk about our overcapacity. As a matter of fact, we have north of 20% overcapacity in our global footprint. And we're a global company. We're in the Americas, we're in Europe, and we're in Asia. And what we have said in 2016, this year, in this transition year, when we work on our profitability, we would like to address the majority of the capacity right-sizing. So, and we have announced already 10% early in the year, which we have very successfully behind us, where we closed a facility in Ohio and moved it into mainly Canada and Shreveport. We have very good facilities there. So it was a move within United States and North America, Canada. And yesterday we have announced that we're going to look at our footprint on the beverage side. Beverage is a very, very, very important segment for us. It's a growth segment for us. However, we felt rather than having 2 to 3 sites that are doing the same stuff, why don't we consolidate our beverage business into one facility for the manufacturing where we really have a good competence? And that's the reason why we decided to move Salisbury, Ohio, our beverage business, into Tijuana. However, only for the assembly. The engineering, of course, stays in North America where it should be. So therefore, I think it is not traumatic, but we're going to help us because when we have this move behind and also the announced move from Singapore into Thailand and China, that's the second plant closure that we've announced. If we have this behind us by the end of the year, we're going to be very close to our 20% reduction target. So again, there we're very pleased with the progress that we have made on the right-sizing front.
All right, and then finally, another touchy political subject is raising the minimum wage. Now, the debate is that if you raise the minimum wage, more restaurant companies are going to go towards technologies like yours. They're going to go towards higher technologies, and that's actually going to put people out of work. Can you talk about whether or not raising the minimum wage is going to help your company?
It is going to help, and I say that continuously. I think the politicians that want to raise minimum wages, they are on the wrong track because this is going to drive the need of automation, and it's going to make every automation case so much better. The same goes for nationalistic approaches where you want to bring everything back into the US. There is a theory of comparative advantages, and I think you need to basically put your manufacturing sites where you have the best comparative advantage. And that is not necessarily driven by national politics. It's more in a global industry where it best fits. And as said, the minimum wages, we have those discussions over in Europe, and the effect is that automation is driven, and we have now these discussions here in North America. And you're going to see more and more kitchen operators taking more and more labor out of their operations and asking for Manitowoc Foodservice equipment because we're a full-line kitchen supplier. And actually, we're currently redesigning, we're revolutionizing the kitchen industry. We are redesigning the processes within the kitchen in order to take labor out, shrink space, and put the output up.
All right, well, thanks a lot for coming on and talking about it.
It was a pleasure. Thank you very much. See you soon.
Thank you for watching The Street.